investment thinking.
Ajit, one of the things that I always enjoyed about thinking about Peter Lynch or reading his book is that you should never water your weeds and cut your flowers. Explain that in layman terms and what it means if you do that in a portfolio.
Well, what he's trying to say is if you own Z, if you own Infosys, and if you own a company like NEPC Micron, for those who remember NEPC Micron.
Yeah, it was a dud.
It was a dud. So if Infosys went up, which it did after listing in 92, 93, 94, you would not be selling not be selling Infosys, selling into strength and buying into the weakness of NEPC Micron. You'd have lost a lot of future, sort of wealth. So what he's really saying is that don't do that. Don't make the mistake of selling your winners and then putting the money into junk. But I think at the same time you have to have a sort of a diversified portfolio, and no one stock should really dominate your portfolio and effectively have a big influence on your wealth. So we knew someone in the late 90s who had 95% of their stock, of their entire wealth in one stock, and to us that was silly. It's not that he owned the business, he was an investor. So even though that stock had done very well, and I'm sure he's very happy about it, it still is very risky because there was a period of time when the stock was not doing well, and I'm sure his wealth got decimated at that point in time.
Strange things can happen in a financial market.
Absolutely, strange things can happen.
What do you think of that? Do you think diversification is good or bad? You are?
No, in a very systematic sort of investment that if you want to follow that, I think diversification is important. That is if you are sort of benchmarking against, if you're a professional fund manager running a fund. But if you are investing your own money, I don't think diversification is a great idea in my view. If you understand the company very well, if you know the business very well, and you know the sort of risk that you're taking, I think you get rewarded only for your conviction ideas. And so just having X stock because it represents 10% of the market is not going to make great sense, because you are there interested in making absolute returns. In that case, I think you need to get probably 4 or 5 good high conviction ideas and buy into them and hold them.
Right. Let's go to John Templeton, and he said the most famous words in stock market investing, this time it's different. Ajit?
Well, again, Sir John, an absolute, guru, legend. He died, unfortunately, very recently.
Recently, yes.
I had the joy and the privilege of working with Mr. Tom Hansberger, who was his partner and who helped set up his firm called Templeton, Goldbeth and Hansberger. And in fact, just to add a little bit to what Sir John said, he said actually there are 5 famous words in investing. This time it's different, and the 5th word you don't hear, and it's sucker.
What's your favorite quote from John Templeton? You are?
Of course, value investing was something that was his sort of contribution to the market, which is extremely important because there's always a dichotomy about value and growth, which is something that I have never been able to understand, because
they're joined at the hip.
It is joined at the hip, absolutely. I mean, unless of course you're looking at value in terms of distress situations, but otherwise value is most often realized when there is growth. Otherwise there is no great value. I mean, unless you're buying an asset at 1/10 the price because it's just about to be sold. Because even there, you have seen even in India lots of companies which hold investments of other companies, listed companies, which get traded at 1/10 their net asset value, but they continue like that for decades because nobody has any intention of selling. So therefore, unless you are going to be able to unlock that value, there is no point in holding value.
I'll read John Templeton's famous quote out there before we go into a break. It says, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria." Any comments on that?
Absolutely. Every euphoria that we saw, whether it's in 2007 or 2000, always had something going for it. Like say, for example, in 2000, the whole idea was that internet is opening up a completely new dimension to business. That everything will be done on the net and everything will be electronic. That came to a very sorry pass. Like say, for example, in 2007, the big housing collapse in the US was juxtaposed on the assumption that US or at least economies have been able to keep interest rates permanently low,
and housing prices keep going up.
They mastered monetary policy. This is what it looked like, and it was not so.
Ajit, are there any new eras
in terms of the
investing?
Absolutely. I think we're kind of living through one right now because we've seen this bull market in India, which is born in the pessimism of post-Lehman. And everyone was so skeptical about the elections coming out in 2009, and then will the world recover, and the green shoots happen, and how long will they last? So all that kind of went on, and we're now probably at the maturing stage of this market now. And again, the retail investor in India has not been part of this, so that's kind of the final indicator. when the retail investor says, yes, I was wrong of not being in, I'm actually taken out whatever 25,000 crores from the Indian mutual funds this year, I'm going to bring that back in. And when they start coming in, that's probably going to be the end of this bull market.
Well, we can always remember that all bull markets die in euphoria, but all television shows go into programming break. We'll take a break, come back and chat some more with UR Bhatt and Ajit Dayal of Quantum.